The accounting equation is one of the most vital parts of financial accounting, and that's because it takes what we've learned so far about assets, liabilities, and equity, and it creates this equation. An equation where it essentially allows us to post all of the transactions that go on within our company. And these transactions, in effect, are going to change those elements like assets and liabilities and equity, because obviously the assets of a corporation or company do not stay the same, they change. So we're going to see how the accounting equation works. And I thought I'd just make a quick few rules. And the first one is that the equation must always balance. The second one being that all transactions must show up on this board. And I thought I would also add a little comment that says just because the accounting equation balances doesn't mean that everything is correct. And we'll see why that is when I illustrate it below. So let's go ahead and actually write our accounting equation. So the accounting equation is assets are equal to liabilities plus equity. And I'm pretty sure I know you're going to say, like, why do assets have to equal liabilities plus equity? Why can't it be liabilities is equal to assets plus equity? And that's because if you think about it, we actually bring in assets, or we create assets by doing one of two things. For instance, if we were trying to raise cash, we can raise cash either from taking on a bank loan of a liability, or we could raise cash by offering a stake in our company through common shares. I know you could also say you could give up cash for cash, and that would be an asset for asset trade, but that makes no sense, obviously. So assets are received by taking on liabilities or by increasing equity, and I think that makes sense. And also another thing is, since assets are dominantly the largest part, it would make sense that they would have to be the largest part, because if liabilities were the largest part of your company, you would possibly be insolvent and always bankrupt. But the fact that your assets are your largest amount means that, let's say if we have something like 10,000 assets and 5,000 liabilities, that we actually do have some value for the owners of the company, which should make sense, because if the liabilities were always the greatest part, we would never have any residual value for the owners. Okay, I think that kind of clears things up why the equation is like that. And let's do some transactions. I'm going to try and draw a straight line. That's horrible. That's horrible too. Okay, I'm just going to stop drawing lines, and I'm just going to say transaction 1. So the first transaction, we're going to talk about a building. So purchasing a building, if we bring on a building, let's say it's $100,000, this is going to increase our asset base by $100,000. I should say building for transaction 1. And we're paying for it in cash, so this is going to be an outflow of another type of asset. So this was all done on the asset side, and you see that it balances because 100,000 minus 100,000 is 0, and if there's 0 on this side and 0 on the right side, then it balances. And that's what we mean by balancing. The left side must always equal the right side. And we must always have 2 transactions or more, because that is the point of the double entry bookkeeping system, because we always must have 2 entries so that we can balance out this equation, 2 or more. Okay, let's do one more transaction. Transaction 2. Let's say that we we issue common shares. So if we're issuing common shares, we're receiving, let's say, $100,000 of cash, and we're increasing our equity by 100,000. And you might have an issue with this because you're like, okay, $100,000 of cash we're receiving, but how is it fair that our equity is also increasing by 100,000? And that's because the ownership is being given up in our company, and we are actually just showing that that the common shares are just a stake in our company for this $100,000. So this isn't really an asset for us. It just shows that the equity or the ownership in our company has increased. Alright, and I guess maybe we should do one more. Let's say we purchase an investment in a stock. So if we purchase an investment, that's going to be an increase as an investment, and it's going to be an outflow of cash because we're investing cash into a certain stock. Let's say, who knows, maybe it's Apple. We think there's going to be long-term growth there, so we invested. And 100,000 minus 100,000 equals 0 on the left side and 0 on the right side. That balances. We can check our work by seeing if the left side equals the right side. 100,000 is equal to positive 100,000. That balances. 100,000 minus 100,000 is 0 on the left side and 0 on the right side, so it balances once again. And that's what we have to make sure. We have to make sure that everything balances. Oh, and I should just note here that just because things don't balance, it's not always correct. And that's because what we can have is we can have duplicate entries, or we can have things like possibly the wrong account being used, or we can have what else? I'm just thinking on the spot right now. We could have possibly, okay, well, I can't remember a third one, but I'm sure you can look in your book for different errors and omissions. Alright, so any questions, leave them below. Make sure to subscribe, and I'll see you guys in the next tutorial.